Welcome back, traders. Every trend eventually reaches key price levels where momentum pauses, reverses, or breaks through. These levels are known as support and resistance. They form because traders remember price levels. Therefore, fear, confidence, and expectations tend to reappear at the same areas on the chart. In this lesson, we'll break down how to spot support and resistance and how to recognize powerful breakouts when they happen. Let's dive in. Support and resistance are critical price levels where the market often pauses or reverses. Think of them as invisible barriers created by trader behavior. Support acts like a floor, where buyers step in and selling pressure slows. Resistance acts like a ceiling, where sellers become active and buying pressure fades. These key levels form because traders remember previous price levels and act on that memory when price returns to those areas. Let's look at resistance first. Resistance is a price level where selling pressure increases. When price reaches this area, it often stops rising or pulls back. Many traders use resistance to take profits, while others look for short selling opportunities. When more sellers step in, upward momentum slows. This happens because traders remember this price level and react emotionally. At Market Mindset University, we emphasize that this is a psychological reaction to price action, not just a technical one. In a strong uptrend, old resistance can become new support. Once price breaks above resistance, it often pulls back to retest that level. Instead of falling further, buyers frequently step in at the old resistance area. This shift shows a change in market behavior. What was once a selling zone becomes a buying zone. This happens because traders now see that level as value, not a barrier. Spotting this role reversal helps you enter trades with the trend, rather than chasing price action. Now let's look at support. Support is a price level where buying pressure increases. When price drops into this area, it often slows down or stops falling. Many traders use support to look for buying opportunities or to place stop losses more safely. As buyers step in, downward momentum weakens. This level attracts buyers who believe price is favorable, shifting control away from sellers. Now, let's walk through the example on the chart. Across the chart, you can see a clear resistance level. Each time price reaches this area, it struggles to move higher and pulls back. That tells us sellers are active here. Below that, price repeatedly finds support, where buying pressure steps in and stops the decline. Eventually, price breaks above resistance. This breakout tells us that buyers have gained control. When price pulls back after the breakout, notice where it stops. It holds near the previous resistance level, and buyers step in again. This confirms the breakout and shows that the market is accepting higher prices. This is how strong trends continue after a breakout. Now it's your turn. Take a moment to look at this chart and identify the key support and resistance levels. Focus only on the clearest areas where price repeatedly reacts. Quiz question: how many clear support and resistance levels can you identify? Is it A, 1, B, 2, C, 3, or D, 4? You have 10 seconds to record your answer. The correct answer is A, 1. If you got this right, you correctly identified the key support and resistance level. This level stands out because price has consistently reversed there, acting as a clear barrier to price movement. Knowing where support and resistance levels are is one thing. Knowing how to use them is where trading decisions are made. Traders apply these levels to plan entries, set profit targets, and manage risk with stop losses. In the next sections, we'll break down how support and resistance help traders make clear, disciplined decisions instead of emotional reactions. Key insight: one important thing to understand is that support and resistance don't carry the same weight in every market condition. When price approaches resistance, it often struggles to move higher. At this level, traders have a few clear options. Some choose to take profits near resistance, expecting price to stall or pull back. Others may look for short selling opportunities, anticipating another rejection from this level. To manage risk, traders often place stop losses just above resistance. This protects them in case price breaks through after multiple attempts. Key insight: in an uptrend, buyers tend to defend support more aggressively, making it the more important level to watch. Let's test your understanding. Take a look at this bearish trend and think about how traders apply support and resistance. Based on the structure of the chart, where would a good potential entry point be? Now let's walk through the choices. Where is the most promising entry point based on support and resistance? Is it A, midway between support and the previous high? B, at the current price? C, at the resistance level? Or D, at the support level? You have 10 seconds to review the options and record your answer. The correct answer is C, at the resistance level. In a bearish trend, resistance is where selling pressure tends to increase. Price often rallies into this area, struggles to move higher, and then turns back down. Entering near resistance gives traders a clear level for risk control and a logical direction aligned with the trend. This works because traders remember these levels and react to them. Now let's flip the script. When price approaches support, buying pressure often starts to increase. At this level, traders have several options. First, they may enter buy trades near support, expecting price to bounce higher. Second, traders often place stop losses just below support to protect against a deeper move lower. And third, if price holds at support and begins to move higher, some traders choose to add to their position as the trend resumes. Key insight: in a downtrend, sellers dominate near resistance, which is why resistance becomes the more important level. Let's test your understanding. Take a look at this bullish trend and think about how traders apply support and resistance. Based on the structure of the chart, where would a good potential entry point be? Now let's look at the choices. Where is the most promising entry point based on support and resistance? Is it A, midway between support and the resistance high? B, at the support level? C, at the resistance level? Or D, at the current price? You have 10 seconds to review the options and record your answer. The correct answer is B, at the support level. In a bullish trend, support is where buyers tend to step in. Price often pulls back to this area, finds support, and then continues higher. This is different from a bearish trend, where traders look to enter near resistance, not support. In other words, bullish trend implies buy near support. Bearish trend implies sell near resistance. This works because traders align their entries with both the trend direction and key price levels. But price doesn't always bounce off these levels. Sometimes, momentum builds and price breaks straight through support or resistance. These moments are called breakouts, and they often lead to strong, fast price moves as traders react all at once. Breakouts signal a shift in control, where buyers or sellers finally overwhelm the other side. This happens because hesitation disappears and conviction takes over. Breakouts happen when price repeatedly tests a support or resistance level without fully breaking it. Over time, pressure builds, and eventually, one side wins. Either buyers push price above resistance, or sellers drive it below support. Sometimes, news or market events can speed up the process, causing prices to break through these key levels quickly. A bullish breakout happens when price breaks above a resistance level. This tells us buyers have gained control and sellers are no longer able to hold price down. When this occurs, momentum often accelerates, and traders look for continuation to the upside. A bearish breakout occurs when price breaks below a support level. This signals that sellers are now in control and buyers are no longer able to hold price up. When this happens, traders often sell, expecting price to continue moving lower. When trading breakouts, timing and risk management are critical. Traders typically enter buy trades when price breaks above resistance, or enter sell trades when price breaks below support. Because breakouts can move quickly, traders focus on entering decisively while managing risk from the start. To protect themselves, traders place a stop loss just outside the breakout level. For bullish breakouts, the stop loss is placed below the breakout point. For bearish breakouts, it's placed above the breakout point. This protects the trade in case the breakout fails and price moves back into the range. Where you place your stop loss above or below a breakout depends on your risk tolerance and how much you're willing to lose on the trade. Some traders place tighter stops, while others allow more room to avoid getting stopped out by normal price movement. Let's test your understanding. Take a look at stock ABC, which has been trading between $50 support and $60 resistance for several weeks. Suddenly, the price breaks above the $60 resistance level and quickly rises to $63. Based on this price movement, what action would you consider? Is it A, avoid trading, B, sell, C, wait and watch, or D, buy? You have 10 seconds to record your answer. The correct answer is D, buy. When price breaks clearly above resistance, it signals strong buying pressure and is likely to continue higher. This shows sellers have become exhausted and the market is accepting higher prices. In this situation, traders often look to buy, expecting the breakout momentum to continue. Traders often confirm this move by monitoring volume, since higher volume helps validate that the breakout is supported by real participation. No matter which option you chose, the key takeaway is this: breakouts create opportunity, but they demand careful analysis. When a breakout is supported by strong momentum and volume, price often continues in the breakout direction. That's where some of the fastest moves in the market come from. However, not all breakouts succeed. That's why successful traders don't just react to breakouts. They confirm them, manage risk, and stay disciplined. Warning: sometimes price pushes briefly beyond a support or resistance level, but then quickly reverses. This is known as a false breakout. False breakouts can catch traders off guard, especially if they enter too soon without confirmation. To avoid false breakouts, traders wait for confirmation. This can mean waiting for a strong close beyond the level, or watching for a retest, where price pulls back and holds above or below the broken level. Traders also look for increased trading volume, since higher volume signals stronger momentum and makes the breakout more reliable. Think like a trader. You've watched price test the $100 resistance level multiple times. Now it breaks through and quickly moves to $105. Your task is to reorder the steps on screen to build a strong breakout strategy. Number each step from 1 to 5, based on how a disciplined trader would plan the trade. Take your time and record your answer. Here's the correct order. First, you identify resistance at $100. Next, you wait for a breakout with strong momentum to confirm buyers are in control. Once the breakout is confirmed, you enter the buy trade. After entering, you place your stop loss below $100 to manage risk if the breakout fails. Finally, you monitor the trade for continuation or signs of reversal. Following this sequence keeps you disciplined and helps you trade breakouts with structure instead of emotion. Lesson complete. You've now mastered how to use support, resistance, and breakouts to make smarter trading decisions. But here's the thing: markets don't always move in clear trends. Sometimes the price moves sideways, consolidation, and gets stuck between key levels with no clear direction. Next, we'll explore how to spot these sideways markets and adjust your strategy to profit from them. Let's keep going. Strong work. We've now completed day 14, lesson 2. By now, your skill set should be leveling up. Up next, we'll focus on how to identify market ranges versus market trends. Keep growing, one step at a time, one lesson at a time.
Ready for more? Get full access to the 30-day trading psychology course at join-mmu.com. VIP YouTube subscribers and email members receive 7-day preview access to new lessons before they move behind the paywall. Join our VIP Inner Circle at mmufreeguide.com to preview upcoming lessons. Keep practicing with purpose and performing with precision. I'm Michelle, and when you're ready, we'll meet you there.